Hello. This is the this is a Tuesday afternoon at 3 p.m. where we always come together to talk about knowledge, knowledge that we really want to share with you. Not because I got nothing to do and I'm just here doing my teaching job, which I'm not a teacher. Guess what? When I was a kid, my dad always wanted me to be a teacher. And then it didn't end up to be that way, but I am doing it. It's not that I want to teach. It's really because these knowledge, you really should already have it. It is should be made available to everyone, and yet it is not because sometimes professionals are having a little hard time to really explain ourselves. So a lot of times my client will say to me that, "Oh, Ying, I really understand what you're saying. And when I was listening to other people, I didn't get it." So I credit that to my Chinglish, right? So English is my second language. I'm not perfect with my language, but because it is my second language, so I always very consciously, every minute of my life, I'm looking for a easy way to express myself. And with that said, it become a work habit, right? So when I have a concept I understood, and then I want to explain to you, and it becoming um, mandatorily easy for you because that's how I do it. So today's topic is about financial statement and the government compliance and audit. You may say that what is that? Why is that a combination? It is such a combination. It is literally is the peas come from the same pot. It is the same thing. So when government come to audit you, they're not looking at anything else. You think they're coming from you, coming from your tax return. No, they're coming from your income statement and balance sheet. And today, what I want to do is I want to tie this for you so you understand when you look at your income statement and balance sheet and you know which part who will audit you. So, all right. So let's go ahead do a sharing here, and I want to run through our slides. Then I will show you what I have for, let me make sure I'm sharing the right one. Maybe not. I suspect that I didn't share you the right screen. Just give me a second. I'll stop sharing this one. What I need to share with you right now is our website because this is the screen. When I project my PowerPoint, it will go there. So here you go. So how financial statement relate to governmental audit and compliance. So in this slides, and I actually go through, this is our website, right? Just really quick, I want you to know to get to our website by communitycpa.com, and you will get to our website. On our website, you see that on board with us, that's how you become our client. And appointments, this is where you can meet us on video calls, and so we can explain things to you. And one of our partner provides free discovery session with you to kind of guide you on where you should go for your question. But the rest of us, when you come to see us online, there is a charge that you would pay online to meet with us. But I'll promise you that that fee you pay, it will be worth a lot, much more than what you actually paid. And we do save people taxes, save our clients situation, and minimize their damages. And so there's so many things we can do. So this is our partner on the list, and I'm on the top. If you book my time, you will see my calendar to see whether I'm available or not. If I'm available, you book it, and I give a 45 minutes video conference, and the fee on there is 375. So with that, and you will see us. All right. So this is our YouTube channel is free. And coming to YouTube channel to subscribe to the channel, you'll get all of our knowledge to you for free. And you can see these are the most recent ones coming out. Subscribe to the channel. That's what I want to let you know. And our firm, we're regional size CPA firm, which means that we're bigger than most of the firms in the city, and we spread out to 4 different states, 5 branches. Houston, Texas is our newest one. Trust me, I probably have 3 others waiting, but Houston is our number 5 newest. It won't be a newest in very quickly. It just that's how we grow, right? So that's how we spread our wings and getting to know more people. So if you believe in our expertise, and you would become our client. And I wrote these 2 books. They're on internet, and you can actually look at the book and then know our journey. The book is literally about community CPA as well, even though I write about our client and the growth path of each business. So the first book, 8 a.m., is when you begin your business. The 10 a.m. is when you grow your business. The 2 p.m., the one I'm writing right now, not published yet, that is how you expand your business. I really felt I'm not done that journey myself yet. That's why it's hard to push that out to become a complete book. So I'm not done. That's why the book is not done. No responsibility disclaimer, very important. Now, let's get to what we are talking about today. Every time people talk about financial statement, they're saying that, hey, you want to borrow money? Give me your financial statement. What are they talking about? They're talking about these 3: income statement, balance sheet, cash flow statement. And I would just want to say this to you. If you have a business that has less than $1 million in sales, your cash flow statement is literally your bank statement. So don't look any further. Don't try to do it. Your bank statement is your cash flow statement. The cash flow statement doesn't equal to bank statement only when you start getting equipment, when you start doing a lot of financing and the short-term lending, loaning, all of these stuff coming through, and then your cash flow statement becomes complex. But normally with a small business, and I just want you to know that a lot of times you can trust your bank statement as a cash flow statement. Income statement and balance sheet are the 2. When you get compliance by the government, they come to audit you, or they just send a letter, inquiry of anything from you, they are zoomed in the income statement, balance sheet. So what I want to show you today is, let's go through income statement and balance sheet, how that interact with the government compliance and audit. So let me stop doing the slideshow with you, and I am going back to my to our Zoom view, and I will share with you the board. This is the board that I have for us today. You see how I already drew income statement, balance sheet. And you also see in the very middle of that, I actually have laid down the common IRS audit or state audit or the compliance side of things. So these are common ones. So I laid it out. For IRS, and you have income tax, you have payroll. So under income tax, IRS income tax audit is very normal, right? You know what that is. They come in, they go, well, you need to pay more taxes. So there they come. So that's IRS. He does income tax audit, also do payroll audit. On the payroll audit side, the IRS actually do 2 things. They audit you 941, which is your payroll taxes. They also audit you for classification. Audit classification means that they want to know your 1099 is 1099, your W-2 is W-2. That's what IRS would audit. But then I want you to look at DOL. DOL also comes to do audit, but their angle of audit is this word of fair. They want to make sure that you as a business owner fair to your worker. So their audit is to look at your W-2, look at your 1099, look at the cash you rent out to the people to decide whether it's fair or not. You see how I did not list immigration. Do they come in as well? Of course they do. But their kind of audit, it is really more not financial related, but you hiring non-documented people to work, someone reported you, so you get audited. So that is where that DOL audit would also come in and they would refer to the immigration. But on the state level, folks, you see, we have workforce payroll audit again. This is the angle about employment insurance, right? So they also audit your payroll. So these purple ones are all payroll audit. And I want you to kind of thinking that, yeah, now you understand the biggest audit area is actually on the payroll. Then the income tax repeated both on the federal and the state side. Then on the state side, we also see something called sales tax audit, right? So with that said, let's just follow our statement. So in our income statement, there are three pieces to the income statement. And if you followed my first webinar, you already know what they are. So the first one, that is your income, right? The second piece, your expense. This one includes the cost of goods sold, and the other expenses, right? So, but they're all expense. Then what is the last piece? The last piece is the profit. This is pretty much math, right? It is the income minus expense equals to profit. And when you have the profit, the tax rate will apply, so the government will get you dollars. So when they do income tax audit, they are ultimately looking at this number. But how do you get this number? They look at here, they look at here. Then they will try to make this number high so you'll pay more taxes. So that's the income tax audit, right? So now let's just look at how income tax audit goes. Let me finish drawing the balance sheet side. The balance sheet side also have three pieces. If you were in our last session, last Tuesday, you know this is asset. Asset including what? Including your bank account and your account receivable, your inventory, and your furniture, or even maybe buildings, depends on what you have. It's all here. Then the second piece is what? Liability. What is liability? Liability are the stuff. It's not yours, but you have it. So loan. Loan. You got it from the bank and you got money from the bank. So asset equals to liability plus what? Plus equity. Basically, use a simple analogy. If I got this pen, I either borrowed money, bought it, or I bought it, right? I either use my equity, I bought it, or I use my liability, I bought it. Or maybe I combined both. I put in down payment, but also borrowed money, so I bought the building. You see how your asset should reflect these two together, right? Add. They add together equals to that. So now let's go back to look at our income tax audit. When the auditor comes to audit you, they look at your income. They actually go to where to look at your income? They look at the bank deposit. You know what the auditor do? They take your bank statement. They already run your bank statement with all the bank deposit. They go, you only reported this amount. Your bank deposit is $1 million more. Explain to me why. There you panicked. You're like, no way. I did not hide any income. I know I deposited everything. And I don't know why, what happened. I actually don't even make money. I lost all the time and I'm so stressed out. You know why? Because your bank deposit includes your income, your sales, and also what? Also loans. The money you put in here. So this is like deposit too. This is your bank deposit. So if you got your mom's dollar with you and to supply yourself in the bank so you can buy a bigger equipment, for example, and please don't let the auditor add a deposit into your income. So that is one. Now, the job is to make you have more profit, make you pay more taxes. So they want to reduce your expense, right? How do they reduce your expense? They say, wow, you bought a machine here. You paid $2,000. And that should not be here. That should be here. If they move your $2,000 from your expense over to here, you don't get that deduction anymore. And then your profit will go higher, right? But of course, nowadays the tax code is more complex than ever. So what the tax code actually do is you can actually do an election to move all of your small amount that is less than 2,500 and even though it's lasts for more than a years and you can still deduct them over here. But the auditor's job is not to help you to do the election, and the auditor don't have to do that for you. They just say that that's an equipment. You're going to use that $2,000 equipment for 5 years. You can't deduct it all in here at once. So you have to come up with that tax treatment to fight with the auditor to keep your deduction over here. So your asset, the higher your asset, the lower your expense, right? So if you have an inventory, you bought $1 million inventory, and then you say that, oh, I don't have money over here, and then you got a zero cost of goods sold. Of course, you're going to pay all the taxes because your cost of goods sold didn't even catch up. So your cost of goods sold and that inventory really should work together. So you should physical count your inventory, make sure it's zero, and then your cost of goods sold will be $1 million. Then your profit will drop. Then you'll pay less income tax. So this red writing I have here give you a summary right here. When you get audited by income tax auditor and you want to watch your asset and watch your loan, because loan, if the loan was classified wrong for you, you pay more taxes. Okay? If the asset was classified wrong for you, you got a lot of asset here. The more asset you have, the less deduction you have. So the higher of the asset, the higher of the taxes. So you want to watch. That's why the auditor don't come just ask you for income statement. They come, they ask for both income statement, balance sheet. This is how that works. Now, let's cover IRS related to payroll. So what IRS do is they focus on payroll right here. They ask you for payroll record. Then they start to articulate, we think that you put too much, you pay too much to 1099. These are all workers. So you owe Social Security, Medicare. So there's a whole bunch of things coming from payroll. So what is the golden rule here? you want to make sure your payroll and your income is roughly around 1/3. So you cannot run a big, huge income and say you don't have payroll. No. So you want to, this is kind of a golden threshold. Of course, can be lower nowadays with AI and with automation. The labor cost is expensive, so people start laying out people, but the work still can be done. So that's just going to drive down this ratio, right? The ratio I'm giving you is today's ratio. So that is where the payroll related to your audit. So sometimes you got an income tax audit, then your payroll also get audited. That is not the same audit. It's actually that same agent probably just 狗拿耗子多管闲事 want to audit both. You know, you got those auditors and they're just really like to expand everything. And that's what they do. They expand. So with that said, this kind of covers our IRS side, right? Now let's look at the DOL side. The DOL side, it is also related to payroll, this one. Department of Labor. This is Department of Labor. I know a lot of you are now get audited by Department of Labor. I know it because we see it coming. Okay. And when you get audited by DOL, what they do is they care about just the fairness. So they want to know how you pay your worker. And you may be doing it wrong. You may be paying them cash. You may be paying them 1099. Forget it. You're just going to give the DOL all the money you paid to the worker. Because if you pay them under the threshold, under the minimum wage, the penalty is so big. If you owe $1 to your worker, DOL right now wants you to pay $2. So it is double of the penalty called the liquidated damage. So just know that DOL, stay away from them. And if they audit you, you come to us and we will work with you on the fairness. But I have not seen any of my clients not paying their worker fairly. You know, the fairness doesn't really happen to our business owners. Our business owners don't treat themselves fairly. They don't pay themselves, but they pay everybody else first. That is really the reality. So every time these kind of audit come, I can't tell you how. Maybe angry is the word, but let's not say angry. Ridiculous. That is just ridiculous because they don't understand the economic environment small businesses are in. They think small business owners are such a moral personality and they're gonna steal with people, steal other people, putting themselves fat, and they don't pay people. But are you kidding me? That only existed in the fairy tale. So that DOL audit is about your payroll again. So if you look at the state, folks, the state one, you see payroll comes again. So when you are a small business owner, what get audited the most is payroll. Where is the payroll? The payroll is in here. So you want to make sure you do your payroll professionally and you do your payroll correctly. If you are a restaurant, you do everybody hourly rate. Everyone who does a minute overtime, pay overtime. Don't try to simplify it. Don't try to get away thinking you won't be audited. DOL knocking doors. I knew one of the DOL agents told me that he actually audited 28 restaurants in 1 month. In 1 month. That's their job quota. That's what they're giving to. No kidding. Just because you don't know, you think it didn't happen? That's like baby play hide and seek, right? Going like, oh, you don't see me, I don't see you. That's just what that is. Don't do that. Now let's talk about the state income tax. The state income tax is the same as federal income tax. They look at the red area I put out, and I want to give you the state audit for the sales tax. So where the state gonna audit sales tax is all inside of your income. So the state will come up with your credit card, sales tax record, your cash, and your checks. And some of the state will use credit card number, like say it is $100. They say the cash sale, it would be $20. They use 20% to say that, if you don't give me your cash record, I will just say you made $20 for every $100 you sell on the credit card. So ridiculous, right? You need to fight it. You cannot just say, okay. If you are the business owner, you get audited by the state government and they give you 20% on cash receipt and you just said, okay, you are not doing a fairness to the rest of the business owners, because if one agree to it, the state will not change their legislature, will not change their practice to lower. Right now, the real practical cash probably between 3 to 8%. Where did I get that number? I got that number from 12,000 businesses. So I know what I'm talking about. 20% is a wrong amount. Maybe it was that way in the 80s, in the 90s even, but not right now. Not this 20 years. It's changed, especially after pandemic. There's nobody gets 20% cash. Nobody. So with that said, you want to know that the sales tax they are doing, it is focusing on your income. You want to break it down properly so you calculate that sales tax properly. Of course, there is another place the sales tax would come. Guess what? Asset. Because, oops, I did this way. Okay? Because when they audit your sales tax, they also audit your use tax. And when you purchase the furniture and asset and things like that for your restaurant, and you need to pay sales tax because your restaurant use it. So it's called the use tax. What they do is they ask you for the asset list that you have. Then they want you to produce receipt. And they can go back to 10 years to ask you to pay. So no kidding, right? So it is important, and you want to make sure that you actually have those equipment purchase receipts saved, or you know where you bought it so you can get that to prove that, yes, I paid use tax and don't charge me again. So they look for income, they look for asset. With that, I sort of covered how your balance sheet, income statement has something to do with your compliance audit from IRS to DOL, from DOL to the state. And under the state, you have income tax audit, use and the sales tax audit, and you also have payroll related workforce audit. And to do your financial statement right, work with your accountant, know which part the government is looking at. That is already giving you half of the answer, how to do a perfect audit, how to minimize your risk, how to come out risk-free, no red flags, right? So that is our ultimate goals when we come through dealing with government compliance audit. All right, I will conclude my talk this afternoon. On Saturday, I will be talking about a golden triangle concept, which is a tax structure for real estate professionals. So I hope you join me on Saturday at 3 p.m. I'll talk to you on Saturday. Bye bye.